I wanted to talk today, specifically about the mortgage market. This is the time of year when people really start looking into their finances. They start deciding that they're going to buy a home in the spring or the summer. I think it's common knowledge that in Tampa Bay, the majority of our moves and relocations happen during the summer. So I wanted to kind of put you guys on the spot a little bit in this first segment and say, what are some of the things people need to do to prepare for qualifying a mortgage? What kind of homework do they need to do? What are some important steps? If they plan to buy a home in June and we're now in the middle of March, what do they need to be doing?
Basically, just speed is the issue. Just because there's, as you know, there's a lack of inventory right now, and the homes that are on the market that are appropriately priced are having multiple offers. So if a buyer wants, finds and wants a home of their dreams, they're gonna have to move quickly. These things. How quickly are you seeing offers come in?
There's some of our homes that are getting 12 offers in 3 days.
Yeah, so
that they're moving super fast, and obviously I would say that that's not the norm for every company. I think we do a little bit better job. I'm gonna pat myself on the back in terms of listing homes and our statistics and how we market them. But I think that is happening in the marketplace right now, where you're seeing that. So they got to be prepared.
So right now, every once in a while, we definitely have buyers that are doing it correctly, and they're, before they're going out and looking, they're getting, all their ducks in a row, getting their documentation reviewed, and that's really the way to go about it. But then there's other people who say, oh, I just saw a house, this morning, I want to make an offer on it tonight, what do I need to do? Well, you need to do this 3 days ago.
Right, exactly. What you need to do is jump in the DeLorean and go back to the future here a little bit, go back in time and start this process a few weeks ago.
We can certainly help. We can certainly jump on that, but there's going to be a time lag. No matter what, we need a few hours to review the documentation.
Let me give you a real life example. So, had a customer call me, old friend of mine actually, looking for a mortgage, and I remember he was a veteran. I said, "Aren't you a veteran?" He goes, "Yeah, that's a great loan." He says, "Yeah, I'm not sure I could get one again, because I had one on a prior house." I said, "Well, let's just find out. Let's get the certificate of eligibility updated and let's see." Okay. Well, now to get that process done, it took about 2 weeks, 10 days or so. All right, to get him to sign the proper waivers to get that information. Come to find out, he didn't qualify for a VA loan. Okay, VA didn't give him any eligibility. So we would have lost 2 weeks in the process, 10 days in the process, if we had done that once the contract was already signed.
Yep.
And so that's bad, And then so we actually went through the whole process. Here's your options. You can do this. You can do that. You can go conventional. You can put more money down. You can eliminate mortgage insurance, or you can put a least amount of money down. You can go FHA. And so before he even put the contract in, he knew he wanted to go FHA.
I think that's something, for our listeners out there, just to kind of define the different loan products that are out there. So, let's talk about the down payments. Someone that's out there that hasn't been in the market a while, because a lot of the programs have changed. A lot of the down payment numbers have changed. Maybe they bought a home 6 or 7 years ago, and now today they're thinking about buying again. What do the down payments look like for the different loan programs?
I think you have two different pools of buyers. Some buyers that want to put down as little as possible, and some people that have a little bit more money to play with, and they can play with their down payment amount. So if we're talking about people that want to put down as little as possible, there's a few programs. Obviously, VA just mentioned, a tremendous loan program. If you're a veteran, if you're active military, that's going to be your probably your end all be all is the VA mortgage. But there's others,
which is no money down. A no money down mortgage, and including your closing costs, can all be covered in, so you don't have to come out of pocket at all.
Correct. And then there's the USDA loan, which is in certain areas you could put down 0%. There is
and USDA, some of those areas like Wesley Chapel out in Fishhawk Ranch. You've got some areas in East Hillsborough and Pasco County that are considered rural, basically, and that's what a USDA area is.
Correct. Then you have your first-time home buyer programs, which basically first-time home buyer is defined as anyone that's owned a home, that hasn't owned a home in 3 years.
Which is crazy, but I love it. I love it.
Right.
But it is kind of interesting. So if you owned a home 4 years ago, you're a first-time home buyer again.
You're a first-time home buyer again, and you can actually qualify for some assistance grants from the state. So right now, in Hillsborough County, there's $15,000 available for first-time home buyers, and outside of Hillsborough, there's $7,500 available, and that can go towards your down payment closing costs. We've closed a bunch of those that were, there's no money out of pocket for the buyer.
That's awesome.
So those are the low down payment options. FHA would be the next tier up, 3.5%. There's actually a couple of 3% down options with conventional as well. So 3 and 3.5%. Though that's kind of your low range.
If you don't qualify for
and
one,
we even have our wealth builder program.
Correct.
For
yeah, brand new.
Millenial.
Forgot about that one.
Yeah. Actually, it's no money down. The wealth builder program. You have to have money You have to show that you have reserves in the bank. Reserves can come from a gift, but actually we can do it with no money down. Now the wealth builder part of it means it's a 20-year amortization, so you're paying down the mortgage a little faster, so that when you get to a point, and we're kind of structured along for millennials, because we know millennials, the biggest problem with millennials is that they don't have a lot of cash.
Right.
But yet, this is probably their first house.
Great income, they got
Once
great
they
income credit.
get their family, they're going to want to get another they're going to want to get to another house. So we create the opportunity to build equity so that when they sell that house, they're going to have money for a down payment on the next house.
And then so you move up to conventional, which is, there's 3% down conventionals, and there's 5% down, and then of course 20% down. Explain the difference to someone listening, why they would put, if they had the 20% down and they were thinking about 10 or 15% down, why would they put the 20% down instead?
Yeah. So basically, anytime you don't put down 20%, you have what's called PMI, or private mortgage insurance. And there's going to be different calculation based on every 5% down payment you make. So at 5% down, you have one calculation for what your PMI rate is going to be. At 10 and 15%, you have a couple different rates. And this is also combined with your credit score and whatnot. So if you put down 20%, that's going to eliminate that PMI altogether. And it's something where, if you're thinking about putting down 15%,
look at the difference.
Look at the difference, and let's just see if it makes sense to put down that additional amount, or if it doesn't. It also could drop off once you reach the necessary equity down the road. So it's a long-term, short-term analysis that we're having with the clients. Is what are your goals for right now? What are your goals for the future for the property?
Also, it's whether you have the option of escrow for your taxes and insurance with the 20% down. So,
Sure.
So
that's another good point. So you can pay those.
So a lot of people say, "Hey, I want to pay my taxes and insurance on my own." Well, if you want that option, you have to put down 20%.
Right, and I think it's known, and obviously lenders are notorious for messing that analysis up. For overestimating or underestimating taxes and insurance, and then you have it either come out of pocket or get a return back. And I'm not saying that you guys, because that's not what you guys do. That would be the servicer and kind of the person that does all that with the loan. But I think it's important to know that if you want to eliminate that ability, and you're also giving them like an interest-free loan in a sense, because you're paying forward those bills instead of just paying them on your own. They're earning the interest on your money instead of you just stroking a check for your tax when it comes out. So there's a lot of viable reasons why someone wouldn't want to escrow, as long as they are budget conscious and responsible.
Yeah, there's definitely different types of people. I think that some people enjoy the convenience of just having it paid. And as far as miscalculations or anything like that, basically, as we discussed last week with Bob Enriquez, the tax bill that we're going to use is the current owner's tax bill.
Correct.
So of course that's going to change next year.
Right.
And you should be aware of what those changes will.
Well, and I think again, sometimes you'll have an issue where your tax or insurance go up, and then your payment goes up, and you don't find out your insurance went up, or there's all kinds of variables that come into play with the escrow reconciliation process that some people just don't want to deal with. And again, I think to each his own, like you mentioned, every person's going to be different in terms of what they want or what they prefer. But that 20% down that you get, it eliminates that as a consideration point, which I think is something that a lot of consumers look at. And then obviously there's the option of cash, which I think we've all talked about on the show. For most people, doesn't make sense. If they're going to pay cash with interest rates as low as they are, with guaranteed returns out there like David Graham has talked about,
exactly.
Why would they pay cash? And again, there's some people that just don't like to have debt. There's some people that prefer to not have that there. But nonetheless, if you're out there and you're considering cash versus a mortgage, think about some other places. Talk to a financial advisor. Listen to David Graham. Talk to some people about maybe some other places where that money could generate a better return than on your mortgage. I think that's
the key to that is that if you had the money and it was earning interest more than what you could get on the after-tax value of your interest, why wouldn't you put it there? And then if you wanted to pay the loan off one day, you have the money there. You have the option, so you could go either way.
So we're going to continue this conversation. We're going to talk after the break. We're going to talk about your tax refund, how that can help you buy a home, how you can put that money back into your home. We're also going to talk about some tips for ways to not turn off potential buyers when you're putting your home on the market, and continue the conversation about the local Tampa real estate market here on the Duncan Duo Show after a quick break on 970 WFLA.